Good morning. Today we will discuss a new topic, that is corporate dividend tax, and also the calculation of surplus or dividend as per the statement of profit and loss. Okay, so we will begin with corporate dividend tax. Now what is corporate dividend tax? So usually the tax on dividend distributed was collected from the shareholders, or previously the tax on dividend distributed was collected from the shareholders, that is the recipients. Actually, the company will be paying dividend to the shareholders, and the shareholders were having the responsibility to pay the tax on dividend. But now companies distributing the dividend pay tax on such dividends. So previously the recipient, that is the shareholders who were receiving the dividend from the joint stock company, were responsible for making payment of tax on dividend distributed. But nowadays the companies which are distributing dividend to the shareholders are having the responsibility to pay the tax on such dividend. So such tax is called corporate dividend tax. That is the tax paid by the corporate entities on the dividend declared or paid by them. So that is the word meaning of corporate dividend tax. Okay, previously the corporate dividend tax or the tax on dividend distributed was paid by the shareholders, that is the recipients, but now it is a responsibility of the corporate entities or the companies who are declaring or paying the dividend. And such tax on dividends are called the corporate dividend tax. Okay, actually these are the tax paid by the corporate entities on the dividend declared or paid by them. So this is the meaning of corporate dividend tax. Then we can move on to various points to be noted in respect of corporate dividend tax. So there are various points to be noted in respect of corporate dividend tax, and the various points are: first of all, the corporate dividend tax is payable within 14 days from the date of declaration. That is declaration of dividend. So corporate dividend tax is payable within 14 days from the date of declaration of dividend. Then comes, it is payable on any amount declared, distributed or paid as dividend. So corporate dividend tax is payable on any amount declared, distributed or paid as dividend. So we have studied the various types of dividend, that is final dividend, interim dividend, declared dividend and so on. Okay, so this corporate dividend tax is payable on any amount, whether it is declared dividend, distributed dividend or paid dividend. Okay, that is including interim dividend. Now it is payable even if no income tax is payable by the company on its total income. That is, in certain years, in case the company does not have to pay any tax on the income, that is income tax on the income, even though this income tax is not paid by the company, it has to pay the corporate dividend tax if the dividend is declared, distributed or paid. That is, this does not depend upon the income tax paid by the company. Okay, so the corporate dividend tax is payable even if no income tax is payable by the company on its total income. Then this corporate dividend tax is shown in note to accounts under the subhead surplus in the statement of profit and loss. Actually, this is surplus in the statement of profit and loss, or the statement of profit and loss, we will be calculating the surplus or deficit. So the surplus or deficit in the statement of profit and loss is actually similar to the profit and loss appropriation account. So usually in companies we used to prepare profit and loss account, profit and loss appropriation account and so on. Now the calculation of surplus or deficit in the statement of profit and loss is somewhat similar to profit and loss appropriation account. Now here we have already stated that corporate dividend tax is payable on any amount declared, distributed or paid as dividend. Now this dividend may be paid either out of current profit or accumulated profit. That is, whether the current profit or accumulated profit is used for the purpose of declaration, distribution or payment of dividend, we have to pay the corporate dividend tax. So these are some of the points to be noted in respect of corporate dividend tax. First one is, it is payable within 14 days from the date of declaration. Then it is payable on any amount declared, distributed or paid as dividend, including interim dividend. Then payable even if there is no income tax to be paid by the company on its total income, then again it is shown in note to accounts under the subhead surplus in the statement of profit and loss, which is similar to profit and loss appropriation account. Hope you understand. Now, regarding the rate of corporate dividend tax. Now you need not bother about all these calculations. You have to note only this rate. Okay, but I'll explain how this 17% is arrived at. Okay, now the basic rate is 15%. Now with that 15%, you have to add surcharge 10%. Now when the surcharge 10% or 15% is added, that is 1.5%. So we will add 1.5% with the basic rate. Then the total comes to 16.55. Then add education cess, that is 3%. That is 3% of 16.55. That comes to 0.495%. Then the total is, that is 16.55 plus the education cess 0.495. The total of corporate dividend tax comes to 16.995, which is rounded to 17%. So this is the way by which the corporate dividend tax of 17% is arrived at. Once again, you need not bother about all these calculations. You must understand only one thing, that is corporate dividend tax comes to 17%. However, the basic rate is 15%, then surcharge 10% is added, then it comes to 16.55. Then when 3% education cess is added to this, that is 0.495, that is 16.5, 3% of 16.5%. Then the total corporate dividend tax is 16.995 rounded to 17%. Okay. Then this is the format of surplus or deficit in the statement of profit and loss. So we have already said that the corporate dividend tax will be shown in note to accounts under the subhead surplus or deficit in the statement of profit and loss. So we must know how to prepare this surplus or deficit in the statement of profit and loss. So this is the format. Now first we will start with the opening balance. So here current year and previous years is given. Usually there will be current year only, that is amount relating to current year only. However, this is the format. You have to maintain columns for current year as well as previous year. Okay, so we will start with the opening balance, that is opening balance of profit and loss account. Then to the opening balance we will add net profit for the year, that is for the current year. Then you will get the total. Then again less various appropriations. So you have to deduct various appropriations from the total profit. And the usual appropriations are transfer to general reserve. Now this we have to explain again. So now you remember transfer to general reserve. Okay. Then transfer to other reserves specified. That is, the name should be specified. Then interim dividend paid, proposed preference dividend, proposed equity dividend, and also corporate dividend tax. So this will be 17% of the dividend. Okay. This is the format, that is opening balance. With that net profit for the year will be added. Then we will deduct various appropriations like transfer to general reserve, transfer to other reserves, interim dividend paid, proposed preference dividend, proposed equity dividend, and also the corporate dividend tax. Then you will get the closing balance, that is closing surplus or deficit in the statement of profit and loss. Okay. Now there is statutory transfer to reserve. Now while talking about this transfer to reserve, I told you that you'll have to explain this point. So this is the explanation regarding this, that is statutory transfer to reserve. So normally a company before declaring dividend transfers a part of the profit to the general reserve. So there is an obligation on the part of the company to transfer a certain amount of profit to the general reserve before it is declaring dividend. Okay, so there is a statutory obligation on the part of any company to transfer a part of the profit to general reserve before they declare any dividend. Okay, now the articles of association may contain provision regarding such transfer to reserve. So the articles of association of the company may contain provisions regarding such transfer to reserves. Then generally board of directors is given discretionary powers in this respect. That is regarding the transfer to reserve. board of directors is given discretionary powers. But section 205 subsection 2A has made it compulsory for the company to transfer certain minimum amount to reserve at a percent not exceeding 10%. Okay. So according to the section 205 subsection 2A, it is compulsory for a company to transfer certain minimum amount to the reserve percentage not exceeding 10%. Okay, regarding statutory transfer to reserve, normally a company before declaring dividend has to transfer a part of their profit to general reserve. Then it is clearly mentioned in articles of association of the company, but board of directors having discretionary powers in this regard. But as per section 205 subsection 2A, it has made compulsory for a company to transfer a certain minimum amount to reserve at a percentage not exceeding 10%. Okay. Now, statutory transfer to reserve, that is, the central government has framed companies transfer of profit to reserve rules 1975. So the central government has framed, so apart from the section 205 subsection 2A, the central government has also framed companies transfer of profits to reserve rules 1975 in this regard. So regarding the statutory transfer to reserve, apart from the other section, the central government has also framed companies transfer of profits to reserve rules 1975. Then amount to be transferred to reserve depends on the rate at which the dividend is declared. That is, the amount to be transferred to reserve, it depends upon the rate at which dividend is declared. Okay, so this is the table showing the amount to be transferred to reserve, that is the statutory transfer to reserve. That is, this column shows the proposed dividend as a as a percentage of paid up capital, and this column shows transfer to reserve as a percentage of current year's profit. So this transfer to reserve actually depends upon the proposed dividend or the rate of proposed dividend. Okay, so in case the proposed rate of dividend is above 10% but up to 12.5%, then the percentage to be transferred, percentage of profit to be transferred to reserve, that is the statutory transfer to reserve, comes to 2.5% of the profit. Okay, in case the proposed dividend is above 10% but up to 12.5%, then the rate or the statutory amount to be transferred to reserve is 2.5% of the profit. Then above 12.5% but up to 15%, then it comes to 5%. Then above 15% but up to 20%, then it is 7.5%. Then finally, in case the proposed dividend is above 20%, then the transfer to reserve comes to 10%. So that is why it is said not exceeding 10%. Okay. So in the point itself, it is said that not exceeding 10%. So in case the proposed dividend is above 20%, then the transfer to reserve will be 10%. So this is regarding the percentage by which the amount should be transferred to reserve, and this depends upon the proposed dividend or the rate of proposed dividend. So above 10% but up to 12.5%, 2.5%, then above 12.5% but up to 15%, 5%, above 15% but up to 20%, 7.5%, then again in case it is above 20%, then it is 10%. Now if the rate of dividend is 10% or less, now here we begin with above 10% only. Okay, if the rate of dividend is 10% or less, then it is not compulsory to transfer a part of the profit to general reserve. However, there is a discretion on the part of the board of directors, and the directors may be opting to transfer a minimum amount for the purpose of strengthening the financial position of the company in future. Okay, so here in case the rate of dividend is 10% or less, it is not a statutory obligation or it is not compulsory for the company to transfer a part of the profit to general reserve. However, the discretion is given to the board of directors, and usually the board of directors will be transferring a certain amount to the general reserve for the purpose of strengthening the financial position of the company in future. So that's all regarding the statutory transfer to reserve, or the points to be noted with regard to statutory transfer to reserve. Now we can move on to the next thing, that is a question. that is how to prepare surplus or statement, or how to ascertain surplus or deficit in the statement of profit and loss. So this is the question. From the following information, prepare surplus or deficit in the statement of profit and loss, that is profit and loss appropriation account. Okay, here net profit for the year is given 25 lakhs. Then balance of statement of profit and loss for the previous year, that is balance of statement of profit and loss of the previous year 10 lakhs. Then 10% preference share capital 5 lakhs. Equity share capital comes to 4 lakhs. The board of directors have proposed 15% dividend on equity shares. Then transfer rupees 51,500 to debenture sinking fund. So this is the question. Then you have to prepare the surplus or deficit according to this format. Okay, on the basis of this particular format, you have to compute the surplus or deficit in the statement of profit and loss. Okay, so this was the question. Then current year's profit is given, then opening balance is given, then preference dividend, equity dividend, then transfer to debenture sinking fund. Okay, then apart from this, two things are not mentioned, that is one is transfer to general reserve. That is depending upon the dividend declared, you have to make a statutory transfer to general reserve. Note the point. Here the transfer to general reserve is not mentioned. So the statutory transfer to general reserve you have to make. Then one more thing is, here the dividend is declared, so you have to compute corporate dividend tax also. So apart from the amounts given in this question, there are two things remaining. One is transfer to general reserve and the other one is corporate dividend tax. Okay. So this is the solution. Now balance of statement of profit and loss for the previous year, that is the opening balance is given, that is the opening balance is 10 lakhs. So opening balance 10 lakhs, then net profit for the year 25 lakhs, that is net profit for the year 25 lakhs. Then preference dividend, that is 10%, that is 10% preference share capital rupees 5 lakhs. So preference dividend will be 10% of 5 lakhs, that comes to 50,000. Then again in the question it is stated that the equity share capital is 4 lakh and the board of directors have proposed 15% dividend. So the dividend on equity share capital will be 15% of 4 lakhs. Okay. So 15% of 4 lakhs comes to 60,000. So the total dividend will be preference dividend 50,000 and equity dividend 60,000. The next is transfer to general reserve, or you can write this, that is transfer to debenture sinking fund is given, that is 51,500. Then there were two things remaining. One is transfer to general reserve. Now regarding the transfer to general reserve, here the dividend declared is 15%. Okay, the company has, the board of directors have proposed 15% dividend. Okay, so the statutory reserve or statutory transfer to reserve depends upon the percentage of proposed dividend. So as per this table, in case the proposed dividend is above 12.5% but up to 15%. So here it is 15%. Okay, so above 12.5% but up to 15%, then the statutory transfer is 5%, or the transfer to reserves comes to 5%. Okay, now we come here, that is transfer to general reserve, that is current year's profit is 25 lakhs. Then as the dividend declared or the proposed dividend is 15%, then the statutory transfer will be 5%, that is 5% of 25 lakhs. It comes to 1,25,000. Then comes corporate dividend tax. Now what about corporate dividend tax? Now the corporate dividend tax, that is 17%, you know the rate, that is 16.995, which is rounded to 17%. So corporate dividend tax is 17% of 1,10,000. Now what is this 1,10,000? That is the preference dividend 50,000 plus equity dividend 60,000. So the total dividend declared by the company comes to 50,000 plus 60,000, that is 1,10,000. So corporate dividend tax, the rate of corporate dividend tax is 17%. Thus the corporate dividend tax comes to 17% of 1,10,000, that is 50,000 plus 60,000. So that comes to 18,700. So the total appropriation includes 50,000 plus 60,000 plus 1,25,000 plus 51,500 plus 18,700, that is 3,05,200. So the total profit was 10 lakh opening balance and current year profit 25 lakhs. So the total comes to 35 lakhs. So when you deduct total appropriation of 3,05,200 from 35 lakhs, then the balance at the end, that is surplus. Here the net profit is more. So it is surplus 31,94,800. Okay. Is it okay? Okay. Now this is another problem. So this is another problem, that is the company carried forward a balance of rupees 40,000 from the profit and loss account from the year ended March 2014. During the year 2014-15, it made a further profit of rupees 3,10,000 before providing taxation. So just note this, before providing taxation. It was decided that the following decisions carried out. Okay, the provision for taxation rupees 1,50,000, dividend equalization reserve rupees 25,000, dividend on 8% preference shares of rupees 2 lakh, dividend at 15% on 30,000 equity shares of rupees 10 each fully paid, general reserve rupees 35,000 and development rebate reserve rupees 35,000. So you have to prepare the profit and loss appropriation account. Now it is already stated that the ascertainment of surplus or deficit according to the statement of profit and loss is similar to profit and loss appropriation account. Okay, so you have to prepare the surplus or deficit in the statement of profit and loss itself. So prepare profit and loss appropriation account and also pass journal entries for the above. So this is the question. Now what are the things given? Carried forward a balance of rupees 40,000 simply means what? That is the opening balance of profit and loss account. So the opening balance of profit and loss account is 40,000. Then the net profit, that is during the year there is a net profit of rupees 3,10,000. Okay, but this is before providing taxation. Now the taxation is given, that is 1,50,000. You know the amount which is available for any appropriation is the amount of profit after taxation, that is the tax you will have to pay. So only after the payment of tax the remaining amount is available for making all these appropriations. So when we take net profit for the current year, then it will be 3,10,000 gross profit, that is total profit, minus provision for taxation 1,50,000. So the net profit during the year will only be 1,60,000, that is 3,10,000 minus provision for taxation 1,50,000. Okay, so rupees 3,10,000 is before providing taxation and the provision for taxation is 1,50,000. So the net available profit for appropriations will be 3,10,000 minus 1,50,000, that comes to 1,60,000. Now there are various appropriations, that is transfer to dividend equalization reserve, then preference dividend, then comes to equity dividend, then transfer to general reserve, transfer to development rebate reserve, etc. Now here, now note this point also, that is general reserve. That is here, the transfer to general reserve is given in the question, that is 35,000. Now again, based on the proposed dividend, what is the rate of amount to be transferred to general reserve, that is statutory transfer? The dividend is 15%. Okay. In case the dividend is above 12% up to 15%, we have to transfer only 5%. Okay. So regarding this rate, it is given that in case it is above 12% but up to 15%, it is 5%. Okay. So only 5% of the net profit you need to transfer. But here again one more point was stated, that the board of directors is having discretionary power regarding transfer to general reserve. That is, board of directors may decide to transfer any amount which is over and above the statutory reserve. So even though the statutory transfer is 5%, it is more than 5%. For example, now here what is the amount of profit? That is 1,60,000. So as per the statute, we have to transfer only 5%. So 5% of 1,60,000 comes to 9,000, I think. Okay, that is 1,60,000 into 5%, it's 9,000. But here then general reserve is, or the transfer to general reserve is 35,000, that which is over and above the statutory transfer. So as the board of directors is given discretionary power in this regard, they can transfer rupees 35,000, and you have to write 35,000 and not 9,000, that is 5%. Okay. So that is all in this case. Now this is the surplus or deficit in the statement of profit and loss. So what is the balance of profit? That is, the balance of profit was, so tell me the amount, that is, which is the amount, or what is the amount? It was, I think, 40,000. Okay. So 40,000. The net profit for the year was 3,10,000 minus the provision for taxation, that is 1,50,000. So it comes to 1,60,000. So total will be 2 lakh. Okay. Then less appropriations. Now regarding the appropriations, the transfer to dividend equalization reserve was, as dividend equalization reserve, 25,000. Then preference dividend, that is, what was the preference dividend? That is, the proposed dividend was 8% on 2 lakhs. So 2 lakh into 8% comes to 16,000. Then equity dividend, that is 15% on 3 lakh. That is 30,000 equity shares of rupees 10 each comes to 3 lakh. And so 15% of 3 lakh will be 45,000. Then transfer to general reserve is already given, that is 35,000. Then transfer to development rebate reserve again is given, that is 35,000. Okay. Then you have to compute corporate dividend tax, that is on 17% of what? Preference dividend is 16,000 and equity dividend is 45,000. So the total comes to 61,000. Preference dividend 16,000 and equity dividend 45,000. So the total comes to 61,000. Okay. So 17% of 61,000 is 10,370. Okay. So 61,000 into 17%, that comes to 10,370. So the total will be, okay, so here the total is 1,66,370 and the balance at the end will be 33,630. Okay, hope it is clear. That is, the opening balance is 40,000. The net profit for the year, that is 3,10,000 minus 1,50,000, 1,60,000. So the total is 2 lakh. Then transfer to dividend equalization reserve 25,000, preference dividend 16,000, equity dividend 45,000, transfer to general reserve 35,000, transfer to development rebate reserve 35,000, then corporate dividend tax, that is 17% of 61,000, 10,350. So the total is 1,66,370. So balance at the end 33,630. Okay. So this is regarding calculation of surplus or deficit in the statement of profit and loss. Okay. Now you have also to make journal entries. That is in the question. Prepare profit and loss appropriation account, that we have already prepared. Then you have to pass journal entry also. Okay. Now what about the journal entry? The first journal entry will be, so this is a charge only. So it will be deducted in profit and loss account, or it will be shown in profit and loss account. So provision for taxation is shown in profit and loss account and all the other things are appropriations. Okay. So the first journal entry will be profit and loss account debtor to provision for taxation 1,50,000. Then all the other things are appropriations. So it will be debited to profit and loss appropriation account. So profit and loss appropriation account debtor to proposed preference dividend. Then profit and loss appropriation account debtor to proposed equity dividend. Profit and loss appropriation account debtor to corporate dividend tax. Profit and loss appropriation account debtor to dividend equalization reserve, general reserve and also development rebate reserve. So nothing, that is all these appropriations. So all these appropriations will be debited to profit and loss appropriation account. So that is why profit and loss appropriation account debtor to dividend equalization reserve, profit and loss appropriation account debtor to preference dividend, profit and loss appropriation account debtor to equity dividend, profit and loss appropriation account debtor to general reserve, then profit and loss appropriation account debtor to development rebate reserve and also profit and loss appropriation account debtor to corporate dividend tax. And the other thing is or the missing thing is provision for tax. So provision for tax you have already deducted from the profit. So the journal entry will be profit and loss, not profit and loss appropriation, but profit and loss accounted to provision for taxation. So this is the journal entry, and this one is the, this one is the solution, that is surplus or deficit in the statement of profit and loss. Hope it is clear. Okay, then thank you.